How UK tax bans work and how to legally pay less. Right, here's something that genuinely bothers me. Most people in this country will hand over hundreds of thousands of pounds in tax over their lifetime, and yet almost nobody actually understands how the system works. And I mean really understands it. Because there's one massive misconception about tax bans that costs people real money, real confidence, and real opportunities. And I want to kill it off today. So whether you're earning 18 grand or 118 grand, stick with me. Because by the end of this video, you'll understand exactly how UK income tax works, and more importantly, you'll know at least 5 completely legal ways to keep more of your own money. Let's start with the big one. The myth. The thing I hear constantly. I don't want a pay rise because it'll push me into the next tax bracket and I'll take home less money. No. No, no, no. That is not how it works. And the fact that so many people believe this, genuinely believe they could lose money by earning more, tells you everything about how badly tax is taught in this country. Which is to say, it isn't taught at all. So here's the truth. The UK uses a progressive tax system. That means you don't pay one single rate on all your income. You pay different rates on different chunks of your income. Think of it like filling up buckets. You fill the first bucket before any water spills into the second one. Let me walk you through the actual numbers for the 2024 to 25 tax year. The first bucket is your personal allowance. That's the first £12,570 you earn. And the tax rate on that? 0. Nothing. You don't pay a penny of income tax on that money. Everyone gets this, well, almost everyone, and I'll come back to that because there's a nasty little trap waiting at 100 grand. The second bucket is the basic rate band. That covers earnings from £12,571 all the way up to £50,270. Everything in that band gets taxed at 20%. Not everything you earn. Just the money that falls within that band. The third bucket is the higher rate band. That's £50,271 up to £125,140. And that's taxed at 40%. And then there's the additional rate. Anything over £125,140 gets taxed at 45%. Now here's why this matters so much. Let's say you're earning £50,000 a year. You do not pay 20% on 50 grand. Here's what actually happens. The first £12,570, taxed at 0. You keep all of it. The remaining £37,430, that's the bit between your personal allowance and your salary, gets taxed at 20%. So you'd pay about £7,486 in income tax. Now imagine you get a pay rise to £55,000. Some people panic. Oh no, I'm in the higher rate band now, I'm going to lose money. But that's not what happens. You don't suddenly pay 40% on the entire 55 grand. You only pay 40% on the £4,730 that sits above the £50,270 threshold. That's an extra £1,892 in tax on that slice. You still take home more money overall. Always. A pay rise will never make you poorer. Full stop. Well, actually, there is one exception. And this is the bit that catches a lot of people off guard. It's called the £100,000 personal allowance trap. And honestly, it's one of the most punishing quirks in the whole tax system. Here's how it works. Once your income goes over £100,000, you start losing your personal allowance. For every £2 you earn above 100 grand, you lose £1 of your tax-free allowance. So by the time you hit £125,140, your personal allowance has completely vanished. Gone. 0. What does that mean in practice? It means that on earnings between £100,000 and £125,140, your effective, your real marginal tax rate isn't 40%. It's actually about 60%. Because you're paying 40% tax on that income and losing your tax-free allowance at the same time. So if you're earning around that level, you really need to pay attention to strategies that can bring your taxable income back down below 100 grand. And I'll get to exactly how you do that in a minute. But first, we can't talk about tax without mentioning the other big deduction on your payslip. National insurance. National insurance contributions, NICs, are essentially another income tax, even though the government doesn't like to call it that. For employees in the current tax year, you pay 8% on earnings between £12,570 and £50,270, and then 2% on anything above that. Your employer also pays NICs on top of your salary, which is why the true cost of employing someone is always higher than their headline salary. So when you add income tax and national insurance together, someone on the basic rate is really paying an effective combined rate of 28% on most of their income. And a higher rate taxpayer is paying 42%. That's a big chunk of your earnings. Which is exactly why it's worth knowing how to legally reduce what you owe. And that's the key word there, legally. We're not talking about dodgy offshore schemes or hiding money under the mattress. We're talking about using the allowances, reliefs, and structures that the government has specifically put in place, often to encourage certain behaviors like saving for retirement or investing. So let's get into it. Here are the main strategies, starting with the single most powerful one. Number 1, pension contributions. This is the big one. Money you put into a pension gets tax relief. That means if you're a basic rate taxpayer and you put £80 into your pension, the government tops it up to £100. That's an instant 25% return on your money before it's even invested. If you're a higher rate taxpayer, you can claim back an additional 20% through your self-assessment tax return, meaning that a £100 pension contribution effectively only costs you £60. And here's where it gets really clever for people caught in that £100,000 trap. If you earn, say, £110,000, and you make £10,000 in pension contributions, your taxable income drops back to £100,000. You get your full personal allowance back, you get the tax relief on the contribution itself, and you've effectively saved at a marginal rate of 60%. That is incredibly powerful. Now, if your employer offers salary sacrifice for pension contributions, even better. Because salary sacrifice means your gross salary is reduced before national insurance is calculated. So you save on NICs as well. Your employer saves too, and good employers will pass some of that saving back into your pension pot. Always check if this is available to you. Always. Number 2, ISAs. You probably already know about ISAs, individual savings accounts, but so many people don't use them properly. You've got a £20,000 annual ISA allowance. That means you can put up to £20,000 a year into ISAs, and any interest, dividends, or capital gains you earn inside that wrapper are completely tax-free. Forever. You've got cash ISAs for your savings. Stocks and shares ISAs for investments. Lifetime ISAs if you're between 18 and 39, where the government adds a 25% bonus on contributions up to £4,000 a year, either towards your first home or retirement. And innovative finance ISAs for peer-to-peer lending, though those are a bit more niche. The point is, every pound you can shelter inside an ISA is a pound that will never be taxed again. Over 10, 20, 30 years, that adds up to a staggering amount of money. Use your allowance. Even if you can't max it out, use what you can. Number 3, marriage allowance. This is free money that millions of couples simply don't claim. If you're married or in a civil partnership, and one of you earns less than the personal allowance, so under £12,570, while the other is a basic rate taxpayer, the lower earner can transfer £1,260 of their unused allowance to their partner. That saves the higher earner up to £252 a year. And you can backdate it up to 4 years, so you could get over £1,000 in one go. It takes about 10 minutes to apply on the HMRC website. 10 minutes for £1,000. That's a pretty good hourly rate. Number 4. Understand your other tax-free allowances. Beyond the personal allowance, there are several other allowances most people forget about. There's the personal savings allowance. Basic rate taxpayers can earn up to £1,000 in savings interest tax-free. Higher rate taxpayers get £500. Additional rate taxpayers get nothing, mind you, but for most people this is a handy little buffer. There's the dividend allowance, currently £500 a year tax-free. If you hold shares outside an ISA, this matters. There's the capital gains tax annual exempt amount, £3,000 for the current year. So if you're selling assets like shares or a second property, the first £3,000 of profit is tax-free. These are all use it or lose it allowances. They don't roll over. So it's worth checking each year whether you're taking full advantage. Number 5, salary sacrifice and workplace benefits. Beyond pensions, many employers offer salary sacrifice schemes for things like cycle to work, electric cars, childcare vouchers if you're still grandfathered into the old scheme, and additional pension contributions. These all reduce your taxable income, which means less income tax and less national insurance. An electric car through salary sacrifice, for example, can be dramatically cheaper than buying or leasing one privately because of the way benefit-in-kind rates are set for zero-emission vehicles. Have a proper look at what your employer offers. A lot of people sign their contract, tick the default boxes, and never revisit it. That's leaving money on the table. And number 6, gift aid. If you donate to charity, even a few quid here and there, make sure you're ticking the gift aid box. It costs you nothing extra, but it lets the charity claim an additional 25p for every pound you give. And if you're a higher or additional rate taxpayer, *U* can claim back the difference between the basic rate and your rate through self-assessment. So a £100 donation to charity could cost you as little as £55 out of pocket if you're on the higher rate. You're doing good and reducing your tax bill. Now, look. I want to be clear about something. Paying tax isn't a bad thing. Tax funds the NHS, our schools, the roads, the whole infrastructure of this country. The goal here isn't to avoid paying your fair share. The goal is to stop paying more than your fair share because you didn't know the rules. And honestly, the rules aren't even that complicated once someone explains them properly. The problem is, nobody does. Not at school. Not at work. Not even most banks or building societies. So here's what I'd suggest as your next steps. First, go and check your tax code. It's on your payslip. Make sure it's right, because HMRC gets it wrong more often than you'd think, and an incorrect tax code could mean you're overpaying right now. If it says 1257L, that's the standard one and you're probably fine. Anything else, look into it. Second, check if you're eligible for marriage allowance. If you are, go claim it today. Literally today. It takes 10 minutes. Third, look at your pension contributions. Are you at least getting the full employer match? Because if you're not, that's free money you're turning down. And fourth, if you're earning anywhere near that £100,000 mark, speak to a qualified financial advisor or accountant. The savings available to you at that level can genuinely be worth thousands of pounds a year. It's not an expense, it's an investment. Right. That is how UK tax bands actually work, and those are 6 real, practical, legal ways to keep more of what you earn. If this helped, do me a favor, hit that subscribe button. I put out videos like this every week, breaking down the stuff that actually matters for your money. No jargon, no fluff, just straight answers. Drop a comment below and tell me, what's the one thing from today's video you're going to act on first? I read every single comment, and I'd genuinely love to know. And if you want to go deeper on any of this, pensions, ISAs, that £100,000 trap, I've got videos on all of them. I'll link the best ones on screen right now. Thanks for watching. I'll see you in the next one.